All right, Dollar Tree, you've probably been there, right? But have you ever stopped to look at its financial report card? Well, today, that's exactly what we're going to do. We're going to deconstruct this retail giant using its own numbers to uncover a story. And trust me, it's a story of wild swings and some pretty surprising contradictions.
So, first things first, let's just get a sense of the scale we're talking about here. This number you're seeing, that's its market capitalization, basically the total value of all its shares combined. And at over $20 billion, yeah, Dollar Tree isn't just some neighborhood shop. It is an absolute force in the American retail landscape.
But here's the thing. That massive size hasn't exactly translated to a stable stock price. I mean, look at this. It's been on a total roller coaster, swinging from around $78 all the way up to over $142 in just the last year. That kind of volatility really makes you wonder, what is actually going on inside this company?
Okay, so our investigation is going to start with the company's growth. And honestly, right away, the numbers start telling two completely, and I mean completely, different stories. Just take a look at this. In the trailing 12 months, or TTM, that's just the most recent year of data, revenue growth absolutely exploded. We're talking over 54%. But then you zoom out, look at the 3- and 5-year trends, and whoa. The company's revenue is actually shrinking. This isn't just growth, it's a whiplash-inducing reversal.
And believe it or not, the story gets even more dramatic when we look at profit. The money the company actually gets to keep. Net income, it just skyrocketed by a staggering 142% in the last year. And again, this is coming after years of decline. I mean, on paper, this looks like one of the most incredible turnarounds you will ever see.
So this right here, this is the core conflict we're dealing with. A spectacular recent year clashing head-on with a long-term slump. It begs the question, right? Which one is the real Dollar Tree? Is this a sustainable turnaround, or is it just a temporary sugar rush? So that naturally brings us to valuation. I mean, with a story this conflicting, how on earth do you figure out what the company is actually worth? Is its stock a bargain, or is it a trap?
All right, to get a handle on valuation, we need to talk about a key metric, the P/E ratio. Now, in simple terms, this number just tells us how much investors are willing to pay for every single dollar of a company's earnings. A high P/E might mean people expect a lot of growth, while a low one, well, that could suggest it's a bargain.
So, Dollar Tree's P/E ratio is sitting at 16.6. Now, a number like that is pretty meaningless in a vacuum, right? It only starts to tell a story when we compare it, to the company's own history, to its competitors, and to the market as a whole.
It really reminds me of that classic Warren Buffett line. Price is what you pay, value is what you get. The stock's price is right there for everyone to see, but its true value? Well, that's what we're trying to uncover here.
And here's where things get really interesting. There's a common valuation model, one that focuses on the company's cash flow, and it estimates Dollar Tree's fair value at almost $164 a share. Now, with the stock currently trading closer to 103, that suggests it could be undervalued by more than 36%. That's a pretty big gap.
Okay, so if it might be undervalued, the very next question has to be, is the business itself healthy? Let's take a look at how efficiently Dollar Tree actually makes money and, what its long-term track record looks like.
A really key measure here is something called return on equity, or ROE. And you can think of it like this. For every single dollar that investors have put into the company, how much profit does it spit out each year? Well, at over 34%, Dollar Tree's ROE is seriously strong. It's a highly efficient profit-making machine. But here we go with another contradiction. Despite being this profit machine we just talked about, owning the stock recently, it's been a pretty painful experience for investors. It's just a classic reminder that a good company isn't always a good stock, at least not in the short term.
And this table, man, it just perfectly captures the stock's wild roller coaster ride. I mean, look at the last few years. Painful losses for anyone who bought in. Just this year so far, it's down over 15%. But then you zoom out and look what happens. Over 10, 15, and especially 20 years, the returns have been absolutely incredible. We're talking about turning long-term investors into huge, huge winners.
Now, if we smooth out those wild swings by looking at the average annual return, a really clear pattern emerges. The 5-year average, it's negative, but the 20-year average is over 13% per year. It's just a stark illustration of that classic battle between short-term pain and long-term patience.
All right, so we've seen a ton of conflicting data. Let's pull it all together now and actually build the two opposing arguments for Dollar Tree. You've got the optimistic bull case versus the pessimistic bear case.
So here it is, the showdown. The bulls, the optimists, they're going to point to that explosive recent growth, the super efficient business, and they'll argue that the stock is a total bargain. But the bears, the pessimists, they're going to fire back, pointing to years of decline, the painful recent losses for investors, and they'll say the volatility is just way too risky.
And that leaves us with one final question. Is Dollar Tree's recent explosive growth the start of a brilliant new chapter? Or are its years of decline a big flashing warning sign of what's to come? You know, the numbers can tell us the story so far, but the next chapter, that has yet to be written.